Welcome, welcome. If you're joining us on Facebook or YouTube, I'm Jim Munchback, professor of personal finance today at the University of Houston, Bauer College of Business, and we should be live on Facebook and YouTube. Now I'm going to jump on over and start the Zoom room, let some folks in, and we'll get started. Good morning, good morning. Good morning. Good to see everybody this morning. If you would, please do me a favor and let me know you can hear me. You can see I have my, not new, but it's new for this program, wearing my AirPods. Good morning. I can hear you. Thank you very much, Ava. Good to see you. Awesome. Okay, we're going to continue today. We're going to continue our personal finance journey into Investing 101. So I want to cover a couple of things that we talked about last week. I want to kind of review a few things, if I can get my screen righty. So just be sure, let's make sure you know that you can pick up this video in our semester's YouTube playlist, and to get there you can go to uhplaylist.com. That's a new feature. Hopefully it helps. Good morning, Alani. Good to see you. So anyway, that's just a reminder, and you're basically going to be going to my YouTube channel. Everything in our playlist is on my YouTube channel, so feel free to subscribe if you want to get notifications. So now I want to jump into what we're going to talk about today. We're going to talk about dollar cost averaging. We're going to start there. So I did this little video, Farmer Joe buys cows. You're going to see that this is the illustration for today's investment strategy, dollar cost averaging. So that's just for fun. Let me see if I can show the chat. I got the chat. I want to make sure I don't miss anything on the chat. I have so much screen real estate. You can't see my screen in my studio, but I have a pretty big screen here in front of me, and then I have my MacBook over there and my iPad down there and my cool little thingy here that I keep reminding you about that's new. So yeah, if I seem a little ADD distracted, it's because I'm a little ADD distracted. I am doing my best though. So okay, I think I did make some changes to the settings. So last week I heard some comments that you guys weren't hearing me all that well. So when I played music, you weren't hearing me. Give me a second. I've got Farmer Joe in the way here. There's the race car, my favorite race car. Okay, any questions before we get started? Looks like we got some folks waiting to get in. Let me let them in. You guys are doing a great job in your Right Capital financial planning portal, getting things set up and ready for your capstone assignment. We'll talk a little bit about that today, your capstone assignment. But today, again, we're just basically moving forward with investing. Investing has been one of the most popular topics in the course, so we spend more than 1 week. Next week, we'll talk about types of accounts. So let me just review a couple of things that we talked about last week. I think last week may have been the first time I introduced you to the perfect investment. The perfect investment is something that, Alani, I think you're the first. Don't forget class collaboration. Okay, I'll get to that. Thank you. Alani wins. Is it 1,000? Are we up to 1,000 free points for being the first? Those are, you really do get 10 points if you need them. Most of you who are here in the Zoom room, you don't really need the extra points. But if you do, if you happen to, just let me know that you earned an extra 10 points. Good job, Alani. I will get to that. Don't let me forget, Alani. It's on you, because I'm going to review the perfect investment. And then I'm going to talk a little bit about the investment strategies that we, hold on, let me get rid of this. Let me get rid of that. Let me get rid of that. I'm pushing the wrong buttons, as you can tell. But this is what we began to introduce last week, the investment strategies, 4 investment strategies. We covered diversification, and we really covered asset allocation. We're going to talk a little bit more about that today, but mainly we're going to talk about dollar cost averaging with Farmer Joe, and then we're going to hit portfolio rebalancing. And then I will jump into next week's lesson and just give you a little bit of a review. So first, though, let me just highlight the perfect investment. The perfect investment. And that's, because I am a certified financial planner, I have to say that there is no perfect investment. But if there was, this would be it. You guys remember what the perfect investment was? I'm looking at thank you, Alani. I'm counting on you to remind me because I have a lot to cover today. And it's fun. This is one of my favorite topics to teach, investment management. And so if I forget to mention the class collaboration before we end, Alani, it is on you to earn those 10 points. So do you guys remember what the perfect investment is? It is listed right there on your page. The perfect, it was right. Ava, you're right. It's 401k. And the reason it's the perfect investment, I just want to highlight and review a little bit why it was the perfect investment. Because when you get that job that you are pretending that you already have, the job your dream job, the job you want to get when you get out of college in your area of study, when you get that job, most likely you're going to have an opportunity to contribute to the 401k plan, which is a company plan, which typically the company will match your investment. They will match a percentage of your contribution to your 401k plan. And so that's the perfect investment because of that company match. And so we use the example, I think, of Shell Oil Company, and I just made these numbers up, but the story was you're making $100,000 and Shell will match 8% of your contribution. And so what I suggested to you, what I encouraged you to do, what I recommended you to do, what I begged you to do was to be ready on day one, when you get that job, to go ahead and say yes with HR when you're doing your orientation and getting everything set up on day one. They're going to ask you, do you want to participate in the 401k plan? And your answer is already made up. It's yes, I do. The next question is, how much do you want to contribute to your 401k plan? And that answer should already be made well in advance because you are going to do a little research before you accept that job to find out what benefits they offer. And one of the biggest benefits offered by any company that makes them competitive, that makes them want to find the best, most qualified candidates and be competitive and attractive to them selecting that company, one of the ways they do that is by setting up a very attractive 401k plan with a feature called company matching. So you want to know what that match is, and when you do, your answer in that first day when you're with HR in orientation, when they ask you how much do you want to contribute, you're already going to know, because if you make $100,000 and they match 8%, how much do you have to contribute to your 401k plan in order for you to benefit from, to receive full benefits of their company match? That's a question. I'm going to wait for an answer. If you're watching on YouTube or Facebook, then go ahead and just give me an answer to that. That is the question. It's not the class collaboration question. It's just the question for right now. So if you're in that plan, you make $100,000 and you have an 8% match from your company, how much would you need to contribute in order to receive that full 8% match? Yes, you would have to, Ava, that's right. Sidra, that's right. You'd have to contribute. You'd have to say, I want to contribute $8,000 to my 401k plan. That's the answer. It's super simple. I mean, maybe the math isn't as simple. I'm making it simple. $100,000, 8%, $8,000. And then the next question is, what happens at the end of the first year after you made that commitment to contribute $8,000 to your 401k plan, what does that look like in terms of your account balance at the end of your first year working for that company? How much money would you have in your 401k plan if you contributed 8% and the company matched 8%? And assuming you make $100,000, super simple math, and the answer is, I don't have my drum roll handy. Bummer. I just removed that button. I usually have a button there for drum roll. Yes, Ava, that's correct. It's pretty simple, right? Is that not, so far, is this perfect investment not a really attractive thing? One of the things we talked about earlier in this semester was Dave Ramsey's 7 baby steps. And one of those steps, which seems kind of intimidating to most people, is to save 15% of your income for retirement. That seems like a hard thing to do, and for many people it is. For so many people, you can't even imagine how many people have the opportunity to contribute to a matching fund to this perfect investment. You can't imagine how many people have the opportunity to do that but don't. And it's just one mistake I do not want any one of you to make. I want every single one of you to be prepared, ready, automatically say yes and know exactly how much you need to contribute to get the full match. Now, you may want to contribute more than that, but at least you want to contribute enough to get the match, because it's 100% return on your investment. So, $16,000 is how much. So if you made $100,000 and you did this and you had an 8% match, which would be a fantastic match, by the way, you're probably not going to get an 8% match, but let's say you get 6 or 7. If you get 7%, that's going to mean that at the end of the first year, you put $7,000 in, they put $7,000, and you're already at 14% of your income saved for retirement. So back to Dave Ramsey's baby steps, that one really hard one about saving 15% for retirement seems ridiculously difficult. But frankly, if you use this perfect investment, you get a little extra boost so that you're pretty much close to that already. It's just like free money, and so don't miss it. The next benefit is the tax deduction. So if any of you are accounting majors, you understand the benefit of a tax deduction. If you contribute 8% to your 401k, the IRS says you made $8,000 or 8%, whatever it is, that dollar amount, that's how much money you made less because you contribute it to your 401k. That's a tax deduction. So the IRS sees that as if you didn't actually make $100,000, you only made $92,000, and you only have to pay tax on $92,000. And that's another benefit. If you're making $100,000 a year, you're going to be paying taxes on it, and you get to save through a tax deduction in your 401k. And the other benefit is you get tax deferred growth. So what that means is if you invest in, we're going to talk about asset classes a little bit. If you understand how they work, and hopefully you do this week, you should be smarter than you were last week about asset classes. And if you understand how that works and you're investing in your 401k, we're going to talk about dollar cost averaging today, and you're going to understand it better. But trust me, if you're just making some simple strategic choices on the front end and you're putting that money into your 401k, it's going to grow, and it's going to grow in a tax deferred way, which means you don't have to pay income tax on any of that growth until you take the money out, which is a fantastic benefit. The other thing is, depending on the company you work for, the 401k plan kind of makes it easy for you to manage your investments. And that's my goal. I'm not here to try to make you an investment guru, because that's just not realistic in one semester. This is Introduction to Personal Finance. And this is Investing 101. It's not advanced investing, although I like what Warren Buffett says. Do you guys ever hear of Warren Buffett? He's like one of the most well-known investors of all time, and he's an old guy from Nebraska. but he's really smart and he has really cool quotes. And one of his quotes that I always liked is, investing isn't like Olympic diving. Okay, investing is not like Olympic diving because you don't get extra points for difficulty. So that just means investing doesn't have to be complicated. And that is my goal for you, is to help you understand investing in a way that is not complicated. And so these 4 investment strategies that we're going to talk about, they are let me get rid of that so you can see all of them. So these 4 investment strategies we started out with last week, these 4 investment strategies are specifically designed for you, meaning you're a young investor, you have a long time horizon. These strategies were selected specifically for you, and they're designed very specifically to help you minimize risk and maximize returns over time. So we started out with the investment strategies, 4 of them: diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. And I think I mentioned diversification. It's like the base foundation of investing. I told you the story about Enron. If you don't know the story about Enron, you might want to do a little, you might want to read about it a little bit. But I had a couple of clients who worked for Enron, and one of them did what the company told them to do: invest more and more and more in Enron, because the stock just kept going up and up and up. But they were cooking the books. And so this man, Bill, had invested all of his money in his 401k in Enron stock. And he had over $1 million, well over $1 million. And when the stock went down, the company said, this is the best time to put even more money into Enron. And he lost everything. He ended up dying of a heart attack from stress, and his wife, who had never worked, had to go to work with no skills. And it was a very sad story, a very personal story for me. I got to work with his widow. And then I had another client who worked for Enron. She was in middle management, and she was smarter. She knew that she needed to be diversified, so she didn't just put all of her money in Enron stock. In fact, she put very little in Enron stock, because the way she thought about it was, the way I want you to think about it is, if you work for a company and you're getting paid from that company, and your number one resource, your income, comes from that company, then you want to be very careful about how much more of your financial future you put at risk by investing in that one company. So you've already got income coming from that company. And I'm not saying you should not buy your company stock. I'm just saying you should be diversified. You should not put too many eggs in that one basket. And since it's the company you work for, you've already risked if that company fails, you're going to be out of an income, out of a job. You're going to lose your income. So that's the story of Enron. The point of that story is to highlight and illustrate the importance of diversification as an investment strategy designed to help you minimize risk and maximize return. So the next one is asset allocation, and there is no more important investment strategy than asset allocation. It's the number one determinant of your portfolio's returns. And so in order for you to understand the way that asset allocation works, it's like diversification on steroids. It's like taking diversification to a whole nother level, a level of strategic design for your portfolio. And it's because of asset classes. Asset classes means you're diversifying not just in a number of investments, a lot of different investments, but you're being very careful to put those investments in different asset classes. And we're going to talk a little bit about that today. But you should have, in your homework, you had lots of information you could take advantage of if you want to understand asset classes. It's very important. The next strategy is one of my favorites, and it's the one we're going to highlight today. It's called dollar cost averaging, and in my opinion, it's the most powerful investment strategy designed to help you minimize risk and maximize return. And you're going to see how that works in just a minute. But again, for younger people with a long time horizon, and for older people who want to just manage risk, dollar cost averaging is an investment strategy that really works well to minimize risk and maximize returns. It's really, in my opinion, again, it's the most powerful investment strategy. Obviously, you get to use dollar cost averaging in connection with or integrated with asset allocation. That's how it works. That's why it works, and you'll see that a little bit today. The next one is very simple. It's called portfolio rebalancing. And if you just always think about a pie, if just in your mind imagine a circle, okay, a pie, cut it in 4 quadrants, 4 pieces of pie in the pie. You only have so much of a pie. That's your portfolio. That's your 401k. And so if you think back about those asset classes, large cap, in fact, let me just jump on over to some asset classes. So these asset classes are listed, but you should know a little bit about them. These are just 4 simple asset classes. There are many, many, many asset classes, but I want you just to think about these types of assets, because when we go back to portfolio rebalancing, the whole idea of portfolio rebalancing is to consider these 4 different, and this is just an example. Again, these are 4 different investment or asset classes, and there are many of them. But these 4 are each one has a different level of risk. Each one of these asset classes responds differently to market movements. Okay, so large cap U.S. stocks, that's companies like Coca-Cola, McDonald's, Apple. These are companies that are based in the United States. They're very large companies, and they're generally pretty safe companies because they're established. So my question to you is, last week I asked you, which one do you think has more risk, a large established company or a small, tiny company that's just getting started? Which one has more risk? And most of you were able to answer that with, yeah, no question about it. The small companies have more risk. But then the question is, which one do you think has more opportunity? Which one has more opportunity for growth? The big, huge established company or a small company with a new brand, with a new name, with something that can change the way we do business, the way you can change our lives? So those small companies have huge potential for outsized gains, but they also have more risk. And that's why having those 2 asset classes in your portfolio, if you're young and you have a long risk horizon, is really smart. The way to do that is you have to pick some kind of investment that will give you exposure to these different asset classes. And I didn't talk about this too much. I did give you plenty of information to review and study. If you want to understand a little bit more about investing and how to invest, you need to understand investment vehicles. And I mentioned 3 of them. One is a mutual fund. In fact, I think what I did, I don't have my elevator here, but let me see if I can get my elevator. So I did show you the elevator. Let me just grab my elevator and I'll put it on the screen. Let me get rid of asset classes. Let me go to iPad, and there you go. That's the elevators. And those elevators So I wanted to illustrate a mutual fund. Forgot what I was illustrating there for a second. So yeah, the mutual fund is one way to get diversification. So you can get exposure to those different asset classes, international, large cap, small cap. You can select any mutual fund, and that mutual fund will be for that specific asset class. Okay, so you could say, I want mutual fund large cap. And in your 401k, that's very much what you're going to have options like that. Like it's going to be a large cap U.S. stock, and it may be a mutual fund. And so this mutual fund, you see on the left side, that's a cable. That's representing diversification. And there's no diversification. That's like buying Enron stock. the elevator on the left. You have one company. If the company goes bad, you lose all your money. On the other side, though, is what Andrea did. She invested in a mutual fund, or at least something that was diversified. With a mutual fund, the mutual fund manager, who you pay a fee to, if you invest in a mutual fund, it costs money. You pay a fee for the mutual fund manager. And the manager's job is to inspect all those cables. Those represent companies. And the manager, the mutual fund manager, will look for the companies that are weak and replace them with a stronger cable. That's the whole point of this illustration. And so what happens is, in these different asset classes, you can select a type of investment to get exposure to these asset classes. A mutual fund is one. Number two would be an index fund. An index fund does not have a manager. So you get all the different companies. You can invest in a large cap index fund, and you pay very low fees because you have no manager. You're just getting exposure to what's called an index. A lot like the S&P 500 is an index. And the reason they call it the S&P 500 is because it's the 500 largest companies in the United States. And that would be a perfect example of large cap U.S. stocks, is the S&P 500. So if I go here, I'm going to just show you, see what the market's doing today. Give me just a second, and I'm going to show you a large cap stock. If I can find it, I'm looking for the SPY. The SPY is an ETF. Now that's different. An ETF, an exchange-traded fund, is different than a mutual fund or an index fund. But it does have one thing in common. I told you 3 investment vehicles, 3 types of investment. A mutual fund with a manager that you pay a fee to, an index fund where you don't pay a fee, but you get exposure to the S&P 500, and that's what the SPY is. The SPY is an ETF, an exchange-traded fund. My favorite type of investment vehicle, an exchange-traded fund. Very, very, very low fees. It's like an index fund. It's better than a mutual fund because you don't have to pay a manager. You just get all 500. You buy one investment in this thing, SPY, and you get all 500 stocks. That's really cool. Trust me, it's really cool. And what makes this better than a mutual fund or an index fund, SPY, is it trades like a stock. So today the market's up. It's up pretty nicely, thank goodness. Okay, back to this. The market's up. So if I decided to invest in SPY today, I could buy it at the price right this minute. If you buy an index fund or a mutual fund, it doesn't work that way. You put your order in now. It's 10:30 in the morning. You put your order in now, and you get the price of that investment at the end of the day. So I don't know if you guys follow the market much, but you could put your order in right now. The market's up. It looks like it's going to keep going up for a while. This is the time of year where the market tends to end strong for lots of reasons I won't get into. But if you're an investment manager, you want to know and understand a few of those things. And if you buy the SPY right now, you get the price right now. But if you put that order in right now, and at the end of the day, let's say that the market has skyrocketed up, you probably wouldn't want to buy it if the market had this ridiculously huge upshot today. You probably want to wait till tomorrow because it's probably going to come back a little bit. But you can't do that with an index fund or a mutual fund. You automatically get the end of day price. And that's why I like, where did we go? That's why I like ETFs, exchange traded funds. And if you look at that chart, hold on. Yeah, if you look at that chart, you can see those big, nasty red candles Those are called candles. Those are daily candles. And you can see that the S&P 500, the SPY, this ETF, in the last 3 days before yesterday, so Friday, Thursday, and Wednesday of last week, wow, it went down a lot, okay? And I want you to just look at that chart and just understand that this is just one chart of one investment. It's called SPY, but it actually represents all 500 of the largest companies in the United States. And you can invest just in this one thing, this one investment, this one ETF, exchange traded fund, and you would have exposure to all 500 companies, largest companies in the United States. So if we looked at another chart, it could be the small cap, it could be the small companies. We could look at another one, it could be international stocks. So you can pick whatever asset class you want, and you would be able to select an exchange-traded fund or a mutual fund or an index fund that would represent that asset class. And it's important to understand that, because when you go back to see that chart, when we talk about dollar cost averaging, you're going to understand why you want to be investing systematically over time. And that's what we're going to talk about now. So let's jump into, let me see if I can find Farmer Joe and get back to the topic at hand. So this is dollar cost averaging. This is my cute little video that I made with cows, just because I wanted to see what I could do with cows. So we're going to talk about Farmer Joe. He's a friend of mine. Farmer Joe is a guy who had some questions about investing. He called me up. He's a farmer, but he didn't have any cows, and he decided he wanted to invest in cows. And so we had a conversation about why invest in cows. What are the benefits? What are the reasons that you wanted to invest in cows? So we talked about a strategy, and Farmer Joe decided that he was going to invest $100 in cows, and he was going to do $100 a month. So that was his plan. Cows, let's just jump right into the cows. Let me see. It's 10:32. I don't want to forget our class participation. So let's do this. Let me see. So last week, tell me if you can you hear that? Well, Alani, can you guys hear that? You can't hear it? You didn't hear anything? Oh my goodness, that stinks. Clips that I played last week from the song The Grand Illusion by Styx. And so I wanted to, this week's class collaboration, are you ready for it? If I had my drum roll here, I would, let me see, do I have a drum roll here? I'm going to find my drum roll, and I'm going to play the drum roll. Can you hear the drum roll? Are you hearing any of the sound? Can you hear that drum roll? Did you hear the drum roll? You didn't hear the drum roll? No. Okay, so I made some settings, and they apparently didn't work. So sorry about that. So this week's class collaboration, I had some music I wanted to play, but instead I'm just going to play a little bit more of a different source of information than the song. And what I want you to do is I want you to think about just what is the idea here. What does it profit a man, a person, a woman, an individual who gains everything? Like they make so much money they can't possibly spend it all. What does that do for them if they lose their own sense of being, their own soul? This is words of Jesus, but there's so many different spiritual writings and principles. And I want you to think about that. I want you just to think about the words of the song that we heard last week and how you guys gave me some great comments about that. But this is just a different question. What does it benefit you if you gain everything? Like if I teach you how, well, get rid of that guy. We don't need that guy anymore. If I teach you how to invest and make a ton of money, what good does it do you if you basically make a lot of money and you have everything you ever wanted? Do you think, you guys already told me the answer to this, do you think it's going to make you happy? Is it going to give you a fulfilling life? And obviously you already know, just like I know, that it won't. That having more stuff and more money isn't going to give you, it's not the answer. It's not happiness and joy and fulfillment doesn't come from that. And yet, we tend to spend a lot of time, a lot of energy, a lot of effort trying to get more. And so one of the things I want to help you think about this semester is not just, I want you to be smart. I want you to invest wisely. I do. I want you to learn everything that I'm going to teach you, especially about investing and all of the things related to personal finance. But mostly I want you to think about that third law of personal finance, which I don't have on the screen here. But the three laws of personal finance are the law of spending and saving, the law of tax advantage investing, which we're going to talk about next week, and the third law. Anybody know what the third law of personal finance is? We've gone over it a couple of times. You've had a couple of homework assignments that included the three laws of personal finance. The third law of personal finance is the law of purpose and commitment. And I want you to be committed to doing the things that you need to do to build wealth and to be as responsible with money as you need to be successful. But I also want you to think about why. What's the reason? What is your purpose? What matters most to you? Because money, no matter how much you make, it's not going to fulfill you. So that's kind of the class collaboration conversation. Just what do you think about those words? Let me see if I can put that back up there, and just think about that and tell me, what do you think? Are these words that Jesus said, do they make sense to you? How do you feel about that? In conjunction with last week's song, America spells competition. Join us in this blind ambition. Get yourself a brand new motor car. That's the song, the lyrics. That was kind of the idea from last week. Now I just want you to kind of put those two ideas together and tell me what you think. And maybe you have some other words of wisdom that you want to share. That's your class collaboration secret for this week. Just to think about that and share a little comment about that, about the purpose, your purpose in relation to money. And, there's no right or wrong answer. That's it. Okay, Alani, we got it covered. Check. We're going to move on now. Okay, let's see. Let's go to Farmer Joe. And I'm going to tell you the story about Farmer Joe. I already started telling you this story, but Farmer Joe decided that he wanted to invest in cows. So instead of just investing in, going out and spending all of his money on cows, I suggested to Farmer Joe, look, the price of cows right now is kind of, here's the conversation. This is what you're going to see at the end. This is my notes, but the first month that Joe decided to invest in cows were $100 a head, okay? And remember, he was going to invest $100 a month, just like you are going to invest X number of dollars in your 401k, and it's going to come out of your paycheck probably every 2 weeks, but you're going to be putting money into the market, right? You're going to select your asset allocation, like we said before. You're going to select which which of these asset classes your 401k contribution is going to go into, because that's one of the questions they're going to ask you in HR, in orientation. Do you want to contribute to your 401k? The answer is going to be yes. The next question is, how much do you want to contribute? And you're going to know the answer because you're going to know how much the match is. So you're already going to know that. The third question they're going to ask you is, where do you want that money to be invested? And you're going to have to choose at that point what asset classes you want your 401k to contain. And then once you start spending that money or investing that money or contributing that money into your 401k, it's automatically going to get allocated to these different asset classes. And I've given you four. Those are four good ones. You could use those and be just fine, or you can select your own. But that's really what your homework is this week, is asset allocation. You have to think about asset allocation. Thus, we have the thinking man. There he is again, my smart thinking man. So you have to think about asset allocation, and you have to decide, what do you want to allocate to? So you need to understand a little bit about asset allocation. But if you just want the easy answer, there you go. 25%, think of a pie, 25% in each asset class. And we're going to get back to Farmer Joe. So Farmer Joe is going to invest $100 a month. It's not his 401k. He's a farmer. He's investing in cows. The first time he invests, the cows are $100 a head. So the first month, how many cows can he buy? The first month that Farmer Joe uses this strategy of dollar cost averaging, investing $100 a month to cows, and cows happen to be $100 a head, how many cows is he going to own at the end of the first month? Going once. That's a question. Looking for an answer, just to make sure you're here. If you're watching on YouTube or Facebook, even if it's 2 a.m. on Saturday, you can answer that. At this point, the question is, Farmer Joe is going to invest $100 a month to buy cows. The first month, cows are $100 a head. How many cows will Farmer Joe be able to buy? The answer is right there on the screen. Thank you, Cedra. Super easy, right? I know, but I just want to make sure you guys are here with me. So that's the first month. He gets 1 head of cows. The second month, though, cows drop to $50 a head. And he's going to invest. Dollar cost averaging is a systematic approach to investing. So he's going to invest $100 a month every month. This month, month 2, he invests $100, and cows are they're $50 a head. So I just gave you the answer. How many cows can you buy if they're $50 a head and you're investing $100? You get 2. You get 2 heads of cows. So imagine, I'm just going to jump back over here, and I'm going to say, get rid of Farmer Joe, get rid of the cows, go back here, get rid of the car. This is SPY, and it's not down 50%, but just like cows, investments like SPY, the S&P 500, they go up and they go down. And if the SPY was down and it was cut in half, and you were investing in the S&P 500 in your 401k, and you had committed to invest $8,000 a year, imagine what would happen in your account if you had this commitment to dollar cost average, which is exactly what you're doing in your 401k, and you're investing in the SPY or the S&P 500, and it drops 50%. How much more of that investment are you going to be able to buy in relation to what you were able to buy the month before or the week before? That's right. It's crazy how much more you're going to be able to get. And the same thing happens with Farmer Joe. The second month, he gets to buy 2 cows. Okay, just keep track of the number of cows. The next month, cows drop to $25 a head. Just like an investment, that can happen in your investments. Something drops to 25%. That's unusual, but when it happens, you're going to be able to buy more of it. So in Farmer Joe's case, he gets to buy 4 cows that month. So again, he's buying cows, he's spending $100, he's investing $100 a month, and the price of cows just keeps changing. Now month number 5 comes along. Is it 5? 1, 2, 3, 4, month number 4. There are 5 cows, so I just gave you the answer again. Farmer Joe is investing $100 a month, and cows drop in month number 4 to $20 a head. How many cows can Farmer Joe buy if he's investing $100 and cows are only $20 a head? Think about that for a minute and give me your answer. I'm looking for an answer. Thank you, Ava. You win five cows. It's pretty simple. So imagine that. Now, if you happen to be Farmer Joe and you're making this investment over time, $100 a month, you're a farmer, you've got chickens, you've got pigs, you've got emu, you have hay, you have all these different things to make money on your farm, and you decided to take advantage of the opportunity to have cows as part of your business plan, and you're investing in cows, and cows went from $100 a head down to $20 a head. What would you do? What would you do? Now, at this point, I got to tell you, Farmer Joe gives me a call, and he's quite upset because he's freaking out, really. He's like, you know what, Jim? You got me into buying cows, and I've been spending $100 a month. And I was like, wait, whoa, Joe, it was your idea. I helped you figure out a strategy, a plan to maximize your returns and minimize your risk. And that's why we set it up this way with $100 a month. And you just spend the $100 investing in cows. And over time, Joe, it's going to work out. In fact, Joe, listen, if I were you today, I would go sell that old John Deere tractor that you've got. I would sell it. I don't know if you guys know about John Deere tractors, but if you buy a John Deere tractor, you're going to spend a whole lot of money on a new John Deere tractor. And if you're a farmer and you buy a new John Deere tractor, good luck getting a technician during harvest time to come and fix your tractor, because after COVID, it's hard to find workers in any business, and John Deere and everybody else who has high-tech equipment require a lot of training and a lot of personnel to be able to keep your equipment running. So the newer it is, if you're a farmer, it's like the more you have to depend on the service department to fix it if it breaks. So Joe has this old John Deere tractor, and it just so happens, I happen to know this to be true, that the old John Deere tractors, the value of those bad boys has just gone through the roof, because there's a whole lot of dudes out there like me who have a toolbox and understand how the old stuff works, and we can fix the old stuff. We can't fix the new stuff. So that old tractor has a value that's higher than it's ever been. It's crazy. So Joe, go sell your old tractor and spend that extra money on cows while they're $20 a head, because you probably won't ever get another opportunity to buy cows this cheap. And that was the whole idea of setting up a plan, a strategy designed to help you minimize risk and maximize returns. Imagine, Joe, if we decided together that when you wanted to invest in cows, we took your whole year's cow budget and we bought cows immediately. There would be some benefits, maybe you'd have some extra cows because they would breed, you'd have more milk, you'd have more leather, you'd have more cow stuff, right? But you would have spent all of your money, your cow budget, up front at $100 a head. And I don't know how many cows you would have gotten, but you would have paid $100 a head. And today, they're $20 a head. So Joe takes a deep breath. He listens to me. He says, okay, I'll keep going. I'm not selling my John Deere tractor, though. He wouldn't do that. So, okay, fine. So that's that. Now, the next month comes along. That would be month number 1, 2, 3, 4. Month number 4. And now cows are back up to, $25 a head? How many cows does Joe get if they're $25 a head? You got it. This is a very simple illustration, right? It's a story about dollar cost averaging and the price of cows, and you probably don't even need me to finish the story, but I'm going to go ahead and finish the story because, I kind of like telling stories. Farmer Joe buys 4 cows. So now month number 1, 2, 3, 4, 5, 6 comes along, and cows have creeped back up, which cows do. They go up and down just like, let me show you. I'm going to show you again real quick. I'm just going to show you this chart. Now this chart is the S&P 500. It's not a cow, but it's like a cow. It's a U.S. large cap stock, and it goes up and down just like cows. And if you're buying it, you could buy it over time using dollar cost averaging, and when the price is down, you're going to be able to buy more, and when the price is up, you're going to buy less. But over time, it's going to minimize your risk. It's going to maximize your returns. I promise. That's why dollar cost averaging, in my opinion, is the most powerful investment strategy that's designed to help you minimize risk and maximize return. And over time, over your lifetime, if you do this, if you do what I'm teaching you to do with these 4 investment strategies in your 401k and in your other investments as well, it's going to be really, really easy for you to achieve the goal that I have for you, the goal that I said at the beginning of this semester I want you to learn how to do, and I want to teach you to do, that I want you to achieve to become a millionaire by the time you're 50. It's going to be really easy if you just take these little things I'm teaching you and you actually do them. Okay, and this one is definitely one you want to do with the perfect investment and dollar cost averaging and the other investment strategies. You will be building wealth over time in a way that's relatively effortless. It's very simple yet powerful, and it's going to help you. This strategy in particular is going to help you minimize risk and maximize returns. So back to Farmer Joe. So Farmer Joe, let's see, yeah, we get to month number. How many months is this, by the way? If you're watching the video, just think about it for a second. Again, I can't help but put this guy up there because he's just right there. The button is right there for Mr. Thinker, and he's thinking. And so he's thinking about how many months have we been doing this in this story. Let's bring it to a close and wrap it up. Month number 1, he gets 1 cow. Month number 2, he gets 3, 4, 5, 6. So he's been doing this for 7 months, right? 7 months, 7, hello, right? And over 7 months, how much money has Farmer Joe actually invested in cows? This is not a trick question. It's really pretty simple and straightforward. It's a question I want you to answer. So the question is, over these 7 months, how much money has Farmer Joe invested in cows? Thank you, Ava. You were right on this. Right on. I appreciate that so much. And your answer, if you can't see it, you can't see it on YouTube because I'm not sharing comments from a Zoom room, but I'll tell you, Ava said $700. So if you had a different number, well, you weren't paying attention because it's pretty simple. 7 months, $100 a month. Thank you very much, Ava. Yep, $700. Now, this question is a little more complicated. This next question, it's a little more complicated. You're going to have to think a little more. Well, I guess first we should say over these 7 months, Farmer Joe's invested $700. This question is going to require that you look at the screen and you're going to have to actually count cows. So over 7 months total, how many cows did Farmer Joe actually buy? How many cows does he own today as a result of investing $100 a month for 7 months, totaling $700? How many cows does Farmer Joe own today? Oh, man, Ava, you were right on. Everyone else asleep at the wheel watching Netflix. There's nothing on Netflix worth watching. I've tried. I canceled Netflix. They keep raising their rates, and I can't let all my extended family use the same account anymore, so it's just not worth it to me. A lot of stuff I don't really care to watch. So if you're watching Netflix, you're not catching the end of the story here with Farmer Joe. You're right. Ava said 19 cows. Now here's the question that can earn you extra points. Not really, fake points. How much money would Joe have in his account if today He decided, which he actually did. He calls me up. He says, okay, Jim, this has been a fun ride. Cows are pretty volatile. I think I want to get out of the cow business. I just can't sleep at night. I'm like, hey, if you can't sleep at night, it's not worth it. No matter how much money you make, it's just not worth it to lose your sleep, lose your soul. You'll lose who you are. You will die. You won't, if you don't sleep, you die. It's like you can't not sleep. And if you're not sleeping, let's get out of cows, because you're right. The price goes up, the price goes down. It's a risky thing. But if he did, which he did, he said, I want to sell all my cows right now. How much money would Joe have in his account? Okay, here we go. Going once, going twice. I want you to think about that one. Oh, yes, Ava's already gone to the last question. How much did he make? How much profit did he make? Which is really good, Ava, but for any remedial students like me, I want to try to think through, first of all, how much money does he have in his account? He put $700 in over 7 months, but he's now selling 19 cows at $100 a head. So how much money does he actually have in his account? It's not an oops. Actually, Ava, you're right, because that's the answer to the next question, which I haven't asked yet, which is how much profit did Joe have? Which is, the answer to that is $1,200. But before I ask how much profit, I just want to know, how much money does he have in his account? If he put $700 in and he bought cows over 7 months and he bought 19 cows and they're worth $100 a head, and he has 19 of them. Thank you very much, Ava. I think everyone else is just gone. It's just you and me. You're the only one participating, and I will never forget you for it, Ava. Thank you so much. So yes, $1,900. And then the final question in this story, and we will move on, is how much profit? When Joe sells those cows, how much profit will he have? And the answer to that question, Ava's already given it to us. It's $1,200. And the reason, remember, again, if Farmer Joe would have bought all of those cows at the beginning, if he would have invested all $700 right away, he would have had 7 cows. And at the end of the 7 months, when cows went way down and then back up, and he said, I'm out, he would have made no profit. And that's how it works. So just remember, again, think about the chart here for the S&P 500. If you invest in the S&P 500, if you invest in small caps, if you invest in bonds, in fact, I'm going to show you a chart for bonds, because you would think bonds are supposed to be safe. If you're not an investor, you don't know this, but I promise you, we in the investment world think and tell people that safe investment is bonds. But this is a chart, TLT. It's an exchange traded fund. Look how far down that's gone. And that's because interest rates have gone up. If you haven't been paying attention, we have inflation, we have interest rates, we have unbelievable debt in the United States, and the U.S. government is issuing bonds and treasuries, and people aren't buying them like they used to. Other countries, China, Japan, they're just not loving them because we have so much debt. It's like we're printing money, and that's a whole nother story. But the point is, bonds are one of those asset classes that we talked about. And because bonds are an asset class, corporate or treasuries, that chart that you just saw is a chart of bonds. So just like cows, just like S&P 500, they go up and they go down. And over time, if you're investing in them in a systematic way, it's called dollar cost averaging, you're going to be able to minimize your risk and maximize your return, because over time, you're going to buy more shares of each of these asset classes. And that is the whole idea of dollar cost averaging. So let's go back to, I want to show you, the last one is portfolio rebalancing. the last investment strategy of the 4 investment strategies that are designed to help you maximize returns and minimize risk. Portfolio rebalancing. And I don't have a picture here, but I want you to just imagine, I want you to think about a circle, a pie, and have 4 quadrants. Okay, 4 quadrants, and each of them represents 25% each. So you've got 4 asset classes. And those 4 asset classes are the ones that we've talked about: large cap, small cap, bonds, international. And those 4 classes, so let's assume that large cap stocks have gone way up, and let's assume that bonds have gone way down. What happened to your circle? What happened to your pie? What happened to that piece of pie that was bonds that went down? And what happened to that piece of pie that was the S&P 500 and it went up? Is your pie still in 4 equal quadrants? Think about that for a minute. It's not. Your pie has shifted. Now you have some asset classes that are smaller. They've gone down just like the cows. So now what we want to do is we want to rebalance that portfolio. Basically, we're going to, like I said, if the S&P 500 went way up, the US large cap stock went way up, and the bonds went way down, like in this situation, that's the bonds, the TLT. What you're going to do is you're going to sell off some of your S&P 500, and you're going to actually turn around and take those profits and invest them in bonds while bonds are way down. So it's like buying more cows. Does that make sense? I hope this makes sense. This is a very powerful, very important strategy, and it is one of the 4 investment strategies that are designed to help you maximize risk and minimize risk and maximize returns, especially over time, because you have a long time horizon. So these 4 investment strategies are really designed for you, and they work really well in your 401k. So I hope that you will start to put this all together in your mind for your 401k. It's very practical. Something I want you to be able to do on day 1 is to set up your 401k at work, take advantage of the company match, and put these 4 investment strategies to work right away, starting right then and there on day 1. And I want you to feel confident about what you're doing. And if you do that, you will then be able to take your investment skills to the next level very easily by just building on the knowledge that you have. And I know that, I promise you it will work. It works really well. So we're out of time, and I'm going to talk about next week's assignment just for a minute. You're going to basically take what we've learned this week about asset classes, and you're going to basically go into your financial plan at Right Capital, and you're going to choose which asset classes you want to have in your investments. And I know these investments are not real. Your 401k in your financial plan should now have some money in it, because you're pretending that you're 10 years older, and you're pretending that you got the job that you really wanted, and you're pretending that you've been investing in your 401k, and now I'm asking you to pretend that you're actually investing in different asset classes, not just a big cash amount in your 401k, but you've actually selected 4 different asset classes at least, and you set up what we call asset allocation, which is the single most important determinant of your portfolio's returns. So that's what you're going to do. You're going to set up your asset allocation in your financial plan this week, and that's going to help you move forward to prepare for your capstone assignment. So again, this week's assignment, next week's assignment, each of these elements will be part of your capstone assignment, which will be a really easy assignment for you to do as long as you keep up, pay attention, and do, get each assignment done. So turn them in early, and I would love to have the opportunity to give you some feedback. If you have any anything that's missing or you need a little help, that's the best way to get it, is turn your assignment in. I'll review it. I'll give you feedback. And then if you turn it in on time, again, let me just mention this as I close, and I'm sorry we're going longer, but a few students have turned their assignments in early, and then once they turned their assignment in early, I gave them some feedback along with some deductions because they were missing something. And then, boom, they resubmitted the assignment before the due date was passed. But they didn't leave a little message to tell me that they already turned it in early and that they were just trying to, make the corrections so that they still get the extra points. And yes, you qualify for the extra points, even if you make mistakes and I give you feedback, as long as you turn it in by the due date, but you have to remind me. So please don't make me have to go back in and exchange emails and all. Just help me out with that if you would. Please. Thank you very much. So I think that's going to do it for today. And I will look forward to seeing you next week. If you have any questions, hit me now. Ava, thanks for all your help and participation. And I am going to go over to the I'm going to finish the broadcast now, so if you've been watching on Facebook or YouTube, I hope you will leave some comments. I was going to say, I hope you will think about what we talked about. And don't forget your class collaboration. So if you're on YouTube, Facebook, thanks for being here. Leave a comment. Let me know you're watching. And don't forget to subscribe to the playlist, to the channel. If you want to get reminders, hit the little bell. Thank you very much. See you next time. I'm going to end it.